it. Welcome to Chart IQ Central. Now, let's get some fast words on how to survive as a trader. You might know some of the topics, but they are absolute crucial to survive as a successful trader. Thanks and take care.
Class is now in session. Welcome, students, to Chart IQ Central. Today, we're moving beyond charts and indicators to discuss the 4 foundational pillars that separate amateur speculators from professional traders. Forget get-rich-quick schemes. This is about building a sustainable career. Our first principle is risk management. Before you even think about profit, you must think about preservation. The single most important tool here is the risk-reward ratio. Imagine you're a professional card player. Would you bet $100 to win 10? Of course not. The risk isn't justified by the potential reward. Similarly, in trading, you should only enter positions where your potential profit is a multiple of your potential loss. A common standard is a 1-to-3 ratio, risking $1 for the chance to make 3. This isn't just a rule, it's a mathematical necessity for long-term survival. Next, we must address the epidemic of overdriving. This is often driven by a psychological affliction known as FOMO, or the fear of missing out. You see a stock soaring and feel an overwhelming urge to jump in, fearing you'll miss the gains. This is emotional decision-making, not strategic execution. It's the equivalent of a scientist contaminating their experiment because they're impatient for a result. Your trading plan, not your feelings, should dictate your actions. If a setup doesn't meet your strict criteria, you do not trade. It is that simple. This brings us to our third pillar, the trading journal. This is not a diary for your feelings. It is a scientific logbook. Every entry must be systematic. Document the date, the asset, your entry price, and your exit price. Critically, you must record your thesis, the precise reason you entered the trade based on your strategy. Was it a specific chart pattern? A fundamental catalyst? Then, you must document the outcome and, most importantly, analyze the result. Was your thesis correct? Did you follow your plan? This log becomes your personal dataset, allowing you to identify your strengths, weaknesses, and refine your methodology with empirical evidence. Finally, we arrive at the virtue of patience. In trading, your edge is a statistical advantage that plays out over a large sample size of trades. A single trade is statistically meaningless. It's like flipping a coin once. It can be heads or tails, but flip it 1,000 times, and you'll approach a 50/50th distribution. Your strategy has a positive expectancy, but it needs time and a sufficient number of trades to realize that expectancy. Patience is the discipline to let your statistical edge work for you. Trade by trade, without getting discouraged by short-term randomness. These are not suggestions, they are imperatives. Master them, and you will build a foundation for a long and successful trading career. That's your assignment. Study these principles, internalize them, and apply them with discipline. Class dismissed. I'll see you in the next lesson. Please hit that like and subscribe button, thanks, and get more inside tips from us on day trading and swing trading.